war brings a lot of economic uncertainty throughout the world. How can I, as an investor, make profitable moves during war-like environments, and how can I invest in such times for dividends? In this video, I'll go through the business of Lockheed Martin and analyze their key fundamentals. As always set with educational purposes and is not meant to be taken as financial advice. Let's make a breakdown of Lockheed Martin's industry specifics so that we can see what is the underlying growth of their business segments. Lockheed's business is divided into 4 parts: aeronautics, missiles and fire control, rotary, and mission systems in space. The global aircraft manufacturing market was valued at $413 billion in 2021, and it is expected to grow by 3.7% annually until 2030. On the provided chart, you can see which continental region will have the most dominance, with North America and Europe leading the way. When it comes to specific aerospace industry demand, most of it comes from commercial aircrafts, then comes the military use cases, then is specific business aircraft use, and then is the segment of others. As stated by EBS World, radar and satellite operations in the US will grow by about 5% in the next 5 years, while the space vehicle and missile manufacturing industry is set to grow by 3.8%. Also, the International Air Transport Association said it expects the number of passengers traveling by air to double to 8.2 billion by 2037. So, from all of this information, we can derive that the upcoming 5-year growth of the industry will be a subpar level, with growth ranging from 3 to 4%. This is in line with this year's Q3 revenue for Lockheed Martin, which grew by 3.5%. To make a further breakdown, 42.7% of the revenue for this quarter, or about $7 billion, is coming from the aeronautics segment. Then, with a 17% revenue share, is the missiles and fire control segment, 2.8 billion in revenue. Rotary and mission systems takes a 22.8% share with a 3.78 billion share, and the space segment takes 17% cut with a revenue of 2.88 billion. In my opinion, the business is quite well diversified, which is a very good thing, and it is amongst the top 3 players in the industry, alongside Boeing and Raytheon. And what gives the company its very big moat is that the defense industry in the US is a top priority, as they are the largest military spender in the world by far. Now, let's take a look at some interesting specifics. Lockheed Martin are implementing quite the share buyback program. Their guidance for the end of 2022 is telling us that they will repurchase up to $8 billion in shares. At their current market cap of $125 billion, this is 6.4% indirect return to investors. It is indirect as it is not a direct cash return. For example, the dividend is a direct cash return. The share repurchases are making it so that the amount of shares outstanding become less and less, and this drives the value of all existing shares upwards. Lockheed are quite the established dividend payer. They are a dividend aristocrat, which means they have been paying out dividends for 25 plus years straight. So let's now analyze them. To find the security of the dividend, we check the dividend payout ratio, which for Lockheed is 0.42. This means that only 42% of their net income is equal to the dividends. Below 50 is a very stable level, and it indicates the dividend could grow in the future and it will not be cut anytime soon. As per the growth up until now, the 5-year annual dividend growth rate is 9.4%, which is a very good level and it beats out the inflation rate. Another way to analyze both the price and the dividend of the stock is to check the historical yield levels. The current yield is 2.31%, which is just above average over the last 20-year history. If the dividend yield is high in relation to historical levels, this means the stock price is low, and if the yield is low, this means the stock price is high. So this is a very good way to analyze both price and yield. From a debt perspective, the long-term debt-to-equity ratio is 0.96, which is just shy of it being too much. And in general, I would like to see a better debt management. The business efficiency is good with a ROIC of 16% and a ROE of 60%. But have in mind that the returns on invested capital and equity are this high due to very high company debt levels. Also, from an earnings perspective, the current PE of 22 is above the average for the company, and when it comes to multiples, it should not be more than 15 at best, as the growth of the company is just not there. When a company is growing by low single digits, the maximum PE we want to pay is 15 or so. When there is no growth, around 10 is a good PE to pay. Also, the debt should be low, the moat high, and the return efficiency should be above 12%. A potential risk for the company could also be a switch in government policies, which make it so that the military spending drops. This would be a very negative factor for Lockheed Martin. In general, the company currently has a strong moat, good efficiency, strong direct and indirect returns stemming from dividends and share buybacks, but its debt management is not perfect, and also the valuation is just too high for a business with such a potential growth rate. If you learned something new from this analysis, please like the video and subscribe to the channel, and also make sure to watch all of my previous stock analysis videos, as you'll find great value in all of them. So goodbye for now, guys, and until the next video.